Okay, good afternoon to everybody, and thanks a lot for the invitation. Being a Swiss, I am not in the EU, I'm not in the EMU, but I'm in Europe, so it's three reasons to be grateful for the invitation. In this presentation, I would like to share with you the experience that we made with macroprudential policy in Switzerland. It's not over, so it's, the current standing. And when I look at the title of the conference and of this session, I should make two first remarks. And the first one is that in Switzerland, our main goal with macroprudential policy is to contain the risk that developments on the mortgage market, on the real estate market, may create for stability in the banking sector. So it's not targeting real estate prices. So in this regard, we are certainly less ambitious than the title of the conference. And second point, regarding the novelty of our instruments, I would say it's more evolution than revolution. Compared to the instruments that have been discussed today, one small novelty is that we use a sectorial countercyclical capital buffer. The buffer applies to residential mortgages. So compared to the Basel III CCYB, we have chosen a more targeted approach. I must insist on the fact that it was not a conceptual matter. The choice was much more a response to the specific situation that we had to address. So what is the problem that we had to deal with in Switzerland? I would say it's probably a textbook example showing the need for a strong macroprudential policy. Since 2008, Switzerland has, like many countries, been confronted with a recession, which was then followed by weak economic growth. And with the extreme appreciation of the Swiss franc, we had first to massively decrease interest rates, and then to introduce a minimum exchange rate floor. It was a 120 floor between the euro and the Swiss franc. Inflation has been close to zero or even negative for a long period of time. And with the abolition of the exchange rate floor, it was in 2015, the negative pressures on inflation have increased again. And monetary policy again had to respond to that situation, and SNB is now charging a negative interest rate of 75 basis points on bank sides accounts with the central bank. And this measure has also brought long-term interest rates into negative territory. We are convinced that our monetary policy is aligned and is necessary given the goal to maintain price stability, but in the long run, it can contribute to the development of imbalances, and it bears risks for financial stability. And these risks have partially emerged. Real estate prices and bank lending have accelerated since 2008, and imbalances have emerged. On this chart, they are measured with the mortgage to trend GDP ratio and with the price to rent ratio. By 2012, we came to the conclusion that macroprudential action was necessary. At that time, the imbalances were still smaller than those that we observed at the end of the 80s and that have led to the last real estate crisis in Switzerland. You can see this from the chart. But we were convinced that without action, those imbalances would probably soon reach levels that would pose a threat to financial stability. And this has led us to take a series of measures. First, in 2012, we have tightened mortgage lending guidelines with regard to amortization and LTV. At least 10% of the collateral value must be financed by the own funds of the borrower, and mortgage loans must be paid down at least up to 2/3 of the loan value within 20 years. Then in 2013 came the CCYB. We activated the CCYB at 1% of the risk-weighted assets related to residential mortgages. This was a sectoral application. Corporate loans were not and are not subject to the CCYB because we did not observe imbalances on that segment. On the contrary, at the time of activation, the concern was much more about a possible credit crunch on the corporate loan segment. Then in 2014, the CCB was increased to 2%, and there was an additional tightening of the lending guidelines with a forced linear amortization. Now, what has been the impact of the measures? The first aspect is that they have contributed to improve the resilience of the banking sector. Following the activation of the CCYB, a number of banks have announced measures to improve their capital situation, and those banks were among the larger, and they were also the closer to the regulatory minimum. So this move was really an improvement in resilience. And on mortgage lending, we observed a modest reduction of the proportion of loans with high LTVs. Second, the measures have coincided, I insist on this word, with a significant decrease of the dynamics on the mortgage market and on the real estate market. On those charts, you see that the green zone shows the zone where we have taken the measures or where they are in place. And you can see that the dynamics has weakened, and indeed imbalances have stabilized. I use the word coincided on purpose because assuming a causality is highly speculative. The only thing that we can directly observe is the difference between the impact of market forces and the impact of regulatory action. Beyond that, we face the traditional identification problem, and not to talk about differentiating between the impact of the CCYB and the tightening of the lending guidelines. In any case, the game is not over for us. Low interest rates have led to a strong decline of banks' interest margins, and the pressure on the margins will continue as bank loans mature and are replaced by loans at a much lower interest rates. At the same time, banks are constrained on the liability side by the zero lower bond, and in Switzerland, the liability margins of the banks are negative. So one danger is that banks increase lending volume or relax their lending standard in order to restore their margins. The perception that low or even negative interest rates may have become the new normal may also affect bank behavior. Banks may be tempted to increase maturity transformation and thereby their exposure to interest rate shocks. And they may also conclude that affordability requirements can be massively relaxed because a lower interest rates automatically improves the debt servicing ratios. And we observe signs in that direction. Banks have increased maturity transformation. This variable is at a high, a historical high. And with regard to lending standards, we also observe some more risk-taking as loan-to-income ratios have substantially increased. It may be true that interest rates will remain durably at a level well below their historical average, and there is plenty of literature explaining why this might be the case. At the same time, it's a fact that the current level of interest rate is a result of monetary policy action without a precedent. And history also tells us that long episodes of low interest rates have sometime been followed by periods of very high interest rate, and that the transition was not always a smooth one. So we need to remain very vigilant in Switzerland, but I think also in other countries. I would also like to perhaps to conclude my intervention with a note of caution, and it regards the balance of powers between monetary policy and macroprudential policy. For monetary policy, the scope for action is defined first by the bank's legal mandate, second, I would say, by what is economically feasible. Okay, of course, central banks also face some legal constraints, but they have a lot of room of maneuver, and they decide alone. This is not the situation that we have with macroprudential policy, and the scope of action is much more limited. The calibration of most instruments is capped. The CCYB, I just mentioned, is capped in most countries at a maximum of 2.5%. Imagine what central banks would say if we were capping the level of interest rate, at a maximum. Okay, that's one first difference. Another difference is that in most countries, the toolkit is limited by the legal framework. We just had a very nice illustration with the German case. And another difference is that for most macroprudential instruments, you have an implementation lag. Here again, it's a big difference with monetary policy. Imagine central banks would give a notice before they increase interest rates, or we should have given a notice before we abolish the minimum exchange rate to the euro. So that's another difference. The last difference is that in most countries, decision-making is shared across many institutions, which also implies some challenge, I would say, with regard to a timely decision. I think that we really need to account for this asymmetry when we build expectations towards macroprudential policy, especially with regard to its ability to compensate the side effects of monetary policy. Thanks a lot.